Is it a good buy? A question that leaves us all keep guessing. When there's a casual conversation about stocks, a common question that comes on our way from friends and colleagues is this: is the stock of company XYZ a good one to buy? Here, XYZ represents the common stock of a company such as Apple, Bank of America, ExxonMobil, or any stocks listed on different stock exchanges, you name it. Before answering that question, let me compare the value of a stock to the speed of a car. As you already know, in normal circumstances, the speed of a car can be measured just by looking at its odometer. But what if the road itself is running along with the car, either in the same direction or the opposite? This may sound out of the ordinary, but unfortunately, figuring out the true present value of a company, which is also known as the intrinsic value, is very similar to measuring the speed of a car running on a road that's moving as well. It's a moving target that can change value based on several different parameters and financial conditions. Or a garbage in, garbage out situation with the assumptions made or the quality of data used to estimate the value. Wall Street gurus may argue that the fair value can be calculated using the discounted cash flow method by discounting all the future cash flows of the company. However, it's virtually impossible for an individual or organization to assess the intrinsic value of a company accurately. Even if they do, it can change if there are new developments within that company or with external macroeconomic factors. This shows how difficult it is to beat the market. After all, we, the rank-and-file investors, are betting against the collective wisdom of the smartest people on Wall Street. A few factors that drain the intrinsic value of a company are as follows. The company misses earnings and drops guidance. The industry, which the organization belongs to, is declining. The products or services of the business become obsolete in the market. The firm is undergoing financial hardships and eventually filing for bankruptcy. The enterprise is intentionally or unintentionally getting into unethical or risky business practices. The corporate is making big mistakes in government compliance or public health and safety aspects, thus imposed with large fines and penalties. The top leadership of the company works for their own selfish motives and not as fiduciaries of its shareholders. The central bank, such as the Federal Reserve, raises the interest rate. A black swan like a war or a pandemic creep in. A recession or depression starts. So on and so forth. On the other hand, a few factors that can positively influence the intrinsic value of a company are as follows. The company experiences significant periods of growth and improves its cash flow projections. The company makes a breakthrough invention or discovery that boosts up its products and services, thus accelerating its earnings, dividends, and cash flow. The market sentiment about the company substantially improves due to a paradigm shift or leadership change in the organization. The central bank reduces the interest rate. The macroeconomic conditions improve and become conducive for business growth. You or your organization may be able to evaluate the intrinsic value based on the historical parameters or a well-formed predictive model such as discounted cash flow. However, always remember, past performance is not indicative of future results. By now you might have understood that stock selection is very much based on risk versus reward considerations, understanding of the company's business model, numerous assumptions, statistical probability, and a bit of luck as well. Therefore, the intrinsic value is not a fixed number, so to speak. Also, it's evident that there is some degree of risk associated with all kinds of stocks available in the market. That is why investment gurus like Warren Buffett and Benjamin Graham always stressed on resorting to margin of safety while determining the purchase price of a stock. Margin of safety is the strategy of playing safe and making sure that the purchase price you choose is well below the intrinsic value. And then there is market price, which is almost always different from the intrinsic value at any given time. A value investor who can make a reasonable assessment of the intrinsic value and buys the shares of the stock much below that value is usually a winner. On the other hand, one who incorrectly calculates the intrinsic value and buys the shares much above the fundamental value, retards their growth potential, or even worse, burns their invested capital. Now let's come back to our original question of, is XYZ a good stock to buy? The short answer would be, it depends. After all, the definition of good is always subjective. If XYZ has a current intrinsic value of $100 and if you are paying $80 for it today, it may be a good deal. Instead, if you buy it for $120, you are suppressing the growth potential of your money or maybe burning your capital itself. If you overpay for the best company in the entire world, the odds are that you may end up losing money on that investment. Once you determine that a company is an excellent investment opportunity, how much you paid for the shares of that company is the crux of the matter. While it's virtually impossible to accurately calculate the intrinsic value of a company, at a bare minimum, you can ask the following questions yourself. Is the company expected to do the business in today's form or better for the next 5 to 10 years, producing above average earnings, cash flow, and dividends? Does the company have strong financial health and reasonable debt structure? Is the company's management demonstrating business integrity, exceptional experience, and strong leadership? Or, are they trying to fatten their pocketbook and family wealth at the expense of their shareholders? What is the central bank's stand on interest rates in the foreseeable future? Are they planning for any interest rate hikes in the near future? Are there talks about a potential war, recession, depression, or a pandemic that is fast spreading? Is my evaluation of the company and its intrinsic value reasonable based on the available data points? Am I overpaying for the stock due to erroneous intrinsic value assessment? Am I exercising sufficient margin of safety while setting the purchase price of the stock? These are some of the basic checkpoints you can make before buying the stock of a company. At least, it's a good starting point. Even after taking these careful steps, the market price can stay irrationally low for a very long time when the market sentiment is bearish. Those who find it too risky or painful choosing individual stocks may be better off investing in a low-cost total market index fund which returns around 10% annually on average. Also, so far, we have not discussed technical indicators using chart patterns. Those sometimes give clues on a stock's price trends. More such strategies will be discussed in detail in our future videos. And that's all for today. Thanks for watching. Please like, share, and subscribe if you found this channel useful.